This reporting period has witnessed historic events as COVID-19 spread beyond China and became a global pandemic. Efforts to contain the virus have led to economic shutdown in Asia, Europe and the US, with unprecedented stimulus applied by central banks and governments to compensate for the loss in productivity. To date, around $3 trillion of stimulus has been deployed, around 3 times the amount during the entire credit crisis and in only 3 months. These events have impacted investment markets with significant falls in equity markets, peaking at around 20% on average, followed by a partial recovery to date. The key developments driving markets at the beginning of the year were US-China relations internationally and Brexit domestically. For now, however, the impact and consequence of COVID-19 will mostly determine market movements until the associated risks have been successfully managed within the global economy. In recent years, there have been several outbreaks which threatened to become global pandemics. SARS broke out in China in 2002, H1N1 or swine flu was first detected in Mexico in 2009, and the most widespread Ebola outbreak came from Guinea in 2013. In each case, the global response was sufficient to trace, contain and eradicate the outbreak without a significant impact on the global economy. COVID-19 initially appeared to follow a similar path, as Chinese restrictions showed evidence of containing the spread of the virus within China, whilst infections outside of China were relatively low. However, with many Chinese tourists spending the Chinese New Year in Milan, drawn by the popular fashion industry, a new infection hub was created. The tactile nature of the Italian culture may have accelerated infections, and due to the 2-week incubation period, the number of infections jumped before officials became alerted to the situation. Italy shut down its economy, with most of Europe and the US following shortly afterwards. The virus had become a massive global challenge, with millions of infections reported worldwide. Central banks and governments have moved to offset the effects of the economic shutdown with unprecedented measures. These policies will not fix the damage caused by the global economic shutdown, but they will allow time for activity to restart. We estimate that most of the global economy can withstand about 3 months of disruption and still be able to restart quickly. After this period, the economic scarring will be more significant, and the restarting process will become progressively more difficult. The UK has now announced a potential path to lifting restrictions, with people encouraged to return to work, schools and shops potentially reopening, and entertainment venues being considered from 1st of July. There are continual benefits due to the innovation and research related to COVID-19, smartphone applications to assist with tracking and tracing infections, a better understanding of the virus transmission mechanism, use of existing and new drugs to reduce the symptoms, and numerous vaccines in development will all help reduce the impact of COVID-19 and ultimately eradicate the threat. The timing and impact of this work is unknown, but is expected to accelerate the ability of the global economy to manage this crisis and the subsequent recovery. The immediate question is, can COVID-19 be controlled to allow the global economy to substantively reopen? We believe this will be the case, and whilst 2020 company earnings will be written down, markets will see potential for 2021 and beyond to recover. This should lead equities to generally recover from current levels, but volatility will remain high due to the level of market anxiety. If COVID-19 cannot be controlled effectively, then further downside risks to equities and bonds will probably emerge, as further government stimulus will become inflationary in effect rather than economically supportive. If, as we anticipate, COVID-19 is controlled successfully, we expect the global markets to recover throughout the remainder of 2020. We are carefully studying the data for signs of a second wave of infections, which could increase risk once more, as well as evidence of inflationary pressures building. The past 3 months have been a difficult time for investment markets around the world, and the future money portfolios have not been immune, each experiencing losses over the quarter. Over the 12 months to 30th of April 2020, future money real value fell by 3.85%, real growth by 6.15%, dynamic growth by 6.93%, and income by 8.16%. Since inception in December 2008, real value has achieved an average annual return of 4.28%, real growth 5.34%, dynamic growth 6.4%, and income 5.46%.